The biggest investment mistake most Australians will ever make probably won't be picking the wrong ETF, buying the wrong stock, or investing at the wrong time. It's usually listening to their own brain. Sounds a bit strange, right? But once you start looking at how people actually behave with money, it makes a lot more sense. Most people don't lose money because they don't have enough information. They lose money because the moment real dollars are on the line, emotions quietly take over, and that's where things start going sideways. One of the most reliable findings in behavioral economics is that losing money hurts a lot more than making the same amount feels good. Think about dropping a $50 note down a drain. You'd probably remember that for ages. Now imagine finding $50 on the footpath. Nice feeling, sure, but it usually doesn't stick with you the same way. Same amount of money, completely different emotional reaction. And once you understand that, a lot of investing behavior that seems irrational suddenly starts making perfect sense. So here's what we're going to cover today, mate. First, we'll look at why your brain was never really built for something like the share market. Then we'll go through the psychological traps that catch so many Australian investors, with real examples instead of textbook theory. After that, we'll talk about what long-term successful investors tend to do differently. And by the end, there's one idea that'll probably change the way you think about every financial decision you make from here on. Quick disclaimer before we jump in. I'm not a financial advisor, and this isn't personal financial advice. Everyone's situation is different. This video is based on behavioral economics and decades of research into how people make financial decisions, so think of it as a way to better understand your own decision-making, not a replacement for advice that's tailored specifically to you. Now let's start with the big picture, because everything else builds from here. Your brain evolved over hundreds of thousands of years to keep you alive. It was built to deal with predators, food shortages, and immediate danger. It definitely wasn't built to calmly watch your investment portfolio fall for weeks or months without doing anything. So when your portfolio drops, your brain can react as if you're facing a real threat, triggering many of the same stress responses that once kept our ancestors alive. And the modern share market, with live prices, breaking news, and constant notifications, pushes those buttons all day long. So if you've ever felt like selling everything during a downturn, you're not weak. That's just old wiring trying to solve a very modern problem. That brings us to loss aversion. In real life, this is why people often hang onto losing investments way longer than they should, hoping they'll bounce back simply because selling means accepting the loss. At the same time, they'll often sell their winners too early because they're worried those gains might disappear. We saw this really clearly during the COVID crash in early 2020, when the ASX fell by more than a third in just a few weeks. Plenty of everyday Australians understandably sold near the bottom, only to watch the market recover strongly not long after. We also saw lots of people switch their super into more conservative options right in the middle of the downturn, locking in losses before eventually switching back after the recovery had already happened. That's not bad luck, mate. That's loss aversion doing exactly what it does. Then you've got herd mentality, or FOMO. The funny thing is, it almost never feels like you're following the crowd. It feels like you've found a great opportunity that everyone else just happens to agree with. But historically, by the time everyone's talking about an investment, a lot of the biggest gains have often already happened. We saw this during the tech boom when companies like Afterpay took off and attracted huge numbers of first-time investors, many of whom jumped in right when prices had already been pushed to very high levels. Next up is confirmation bias, and this one's a bit more subtle. Once you've decided you like an investment, your brain naturally starts paying more attention to information that says you're right, while quietly ignoring information that says you might be wrong. Buy a stock today, and if some negative news comes out tomorrow, confirmation bias is what makes you brush it off as nothing, even though the exact same news probably would have made you think twice before buying it in the first place. Then there's recency bias. That's our habit of believing whatever's been happening lately will just keep happening forever. If the market's been going up, people expect it to keep climbing. If it's been falling, people assume it'll never stop. You can see this in the property market too, where people rush into bidding wars because prices have been rising recently, not necessarily because the numbers actually make sense. And then there's overconfidence. A couple of successful investments can make people feel like they've cracked the code. That's usually when they stop diversifying, put too much money into one or two companies, or start believing they can consistently beat the market. Ironically, it's often not the first successful investment that causes problems. It's the second or third, when confidence quietly turns into certainty. Here's the interesting part, mate. The market doesn't really care how smart you are. What it keeps testing is your patience and your discipline. Over long periods of time, investors who simply stay invested and avoid constantly reacting to short-term market moves often end up doing better than people who are always trying to outsmart the market. Investing isn't really a competition to see who's the smartest. More often than not, it's a test of who can stay consistent. So what actually separates people who build wealth over the long run from those who keep repeating the same mistakes? It's usually not some secret strategy. They focus on long-term goals instead of getting caught up in today's headlines. They don't obsess over daily price movements because they know those swings don't matter much over decades. They invest consistently instead of trying to perfectly time the market, something even most professional fund managers struggle to do. They diversify so one bad investment can't wreck everything, and they stick to a plan they made when they were thinking calmly instead of making emotional decisions in the middle of market chaos. Markets will always go up and down. News headlines will always tell you to panic or get excited about something. But the one thing you'll take into every investment decision for the rest of your life is your own psychology. At the end of the day, the market isn't asking whether you're intelligent, mate. It's asking whether you can stay calm and rational when everyone else is losing their heads. If this video made you think of someone who panic sold during a downturn, or someone who's chasing whatever everyone's talking about right now, send it their way. It might genuinely help them avoid making the same mistake. And I'd love to hear from you as well. Out of loss aversion, herd mentality, confirmation bias, recency bias, and overconfidence, which one do you reckon catches you out the most? Let me know in the comments. I read every single one.